So in this case with the machinery, and let's have a look at this one in particular. So that piece of machinery has a tax base of 180, a carrying amount of 190. We know it's a 10,000 difference. We don't need to really think about that too much. The tax base is less than the carrying amount. We have a deferred tax liability of $3,000. Now, if we look at what's happening there, the tax base is saying we have, it's almost like a counterfactual. The tax base is saying we have $180,000 of deductions left, and those are actual deductions. But had we been using accounting to get our deductions, we would still have $190,000 of deductions. So we're actually going to, in a sense, because of the way we've done this and the way those differences are split out, we're actually going to pay $3,000 more tax over the next 19 years or so. But the only reason we're paying more tax over that period of time is because we've paid less tax to date. Because we've actually been able to claim $20,000 of deductions rather than 10. Overall, you're still going to get $200,000 of deductions, and you're going to pay less. You're going to pay less tax to the tune of $60,000. But it's just when that happens, because you get a greater amount of deductions now, you'll get lower deductions in the future, and you'll, in effect, pay more tax than you otherwise would have. And that needs some time to sink in. Given that we have a DTL, and if we just started with 0, we just see a DTL and we see a tax expense getting picked up on that. I actually find the liabilities a bit easy to work my head around. And the easy thing is, remember what we were talking about before? If the tax base is less than the carrying amount, but the way that you define the tax base, I can't think of one example where I've seen a tax base greater than the carrying amount. So pretty much you can be, I would say 99% sure that if you have a liability, you're going to have and if you're going to have a temporary difference on the liability, you're going to have a DTA. Which means you can pretty much just remember, if you've got a liability, it's a DTA, and then look at the signs, go, okay, well, tax base is less than the carrying amount. Then just flip the sign around for assets and just have a look at what they're doing. And you, just by remembering one thing, you can actually remember all of it. So if we have that long service leave, again, we actually already figured this out. We have a difference. We know we've got that $15,000 difference, and intuitively, we know that when we pay it, we're going to pay less tax. So that's a good thing. So if the tax base for liability is less than its carrying amount, we have that DTA. Because, where is it? If we'd accounted for that using, if we got the tax deductions based on how we done it for accounting, we would have $50,000. Let's try to think here. We got lost here. It is just the reverse. That time in the evening when you have a mental blank. Come back. It'll come to me. We've already had the expense for it. That's right. So for accounting purposes, we've had that expense. And so for accounting purposes, we would have been getting the deductions already. So we would have actually already got the deductions if we'd been allowed to use the accounting as a way we get the deduction. Because we calculate out that provision, we calculated small expense each period, and so on. But because we weren't able to use it, when we do it for tax, we actually will get that deduction down the line because we haven't got the deductions already. So we have this future deduction sitting there, and we will pay less tax down the line. And so I think, not as well as explained as it could have been, but you know intuitively with that, you will get a benefit from it, so you'll pay less tax. Now, this is drawing out the DTA effect, which we referenced earlier. So we'll do this. There's one more thing I want to do before the break, and then we'll take a couple of minutes. A DTA is only recognised when it's probable that taxable profits will be available against which the deductible temporary differences can be utilised. So, this bit. An entity shall reduce the carrying amount of a deferred tax asset to the extent that it is no longer probable that sufficient taxable profit will be available. So you can only pick up a DTA if you think you're actually going to make taxable profits in the future. Because you can only pay less tax if you're actually going to pay tax in the future. So I think that was that's sort of the add-on from what you were saying earlier, that it's not so much the tax now that they're paying, it's if they don't think they're never going to pay tax in the future, then you're not going to get any you're not going to pay less tax because you never had tax you're going to pay in the future. That is a massive red flag if you see a company writing off its DTAs. Now, odds on, if they're writing off their DTAs, there's a whole lot of other stuff that's going on. So I don't think you're going to know that there's something wrong. But definitely if you see them writing that off, that's problematic. And to finish with, or at least finish with before the break, this is a company I'd imagine most of you have heard of. I think it'd be rare to find someone in the world that hasn't heard of this company. I think it's a company, depending, some of you, maybe a few of you have probably spent time in. I know I've spent far too much time in this place. When we moved overseas last year, we were only going to be there for a short time, so the place we got was unfurnished, and there was no point getting kind of good stuff. So we basically decked everything out with Ikea, and it's just so easy to get lost in those places. Now, not talking about, that said, $1 hot dogs are quite good. If you're trying to ignore what they're possibly made of. The thing which is of interest though is not so much the quality of their food or the layout of their stores and what they're doing, but it's a transfer pricing issue because we'll have a look at it. So this is information from a couple of years back because they're a private company, it's hard to get access to them, but for some reason people were able to get access to them in 2011. So this is actually from a newspaper report where this came from. Someone had done some digging into them. So Ikea Proprietary Limited, I realise this is sending the corporate group a bit upside down, but so nonetheless. In that particular year, their revenue in Australia, and they only have like 3 stores or something, 3 or 4 stores in the country. So I mean, you know, not too many. They made over $500 million of revenue. So you know, there are a lot of Billy bookcases in Australian houses around the country. Their net profit before tax was under $10 million. So just think about that for a second. I don't have a calculator on hand, but that doesn't seem like an awfully large profit margin. So that's like 2%? Thereabouts. Now if you look at the tax that they paid on that, $2.5 million on that $9.5 million, that looks about right. That looks about 30%, give or take. Then let's have a look at their parent. Their global revenue was about $32.5 billion. So there's a lot of Ikea, that's just 1 year, there's a lot of Ikea in houses around the world. Their net profit after tax was about nearly $4 billion. So you can already see that there's something different going on there. Their net profit in that case is over 10, their net profit margin is over 10%, whereas in Australia it's about 2%. And if you've ever compared, and actually a current affair still exists. Today tonight's, one of them is gone, one of them is still going. But a couple of years back, they ran a story on, you know, Australians are getting ripped. I mean, it's one of their sort of stable of stories they'll roll through every so often. You know, Australians are getting ripped off. We pay for the same thing in the US. They'd pay this for the same bookcase here. We're paying, you know, even with exchange rates, we're paying like double the price of it. You could go, yeah, well, fair enough, but fine, buy a bookcase in the US and ship it over and see how much it ends up costing you. I mean, we're a market where they can do that. It doesn't matter if it's fair or not. So arguably, you could say that their profit margins here should, if anything, be higher than what there are elsewhere, but they seem drastically lower. And that's transfer pricing, a very similar thing what we saw Apple do, or Apple doing, is that what they're basically buying in terms of product and they're getting shipped to Australia, marking that up. And I don't know the exact numbers for it, but if a Billy bookcase costs you $100, they could be having that sold to them for like $90. And so they're already kind of lowering the profit that they have here to try to shift profits outside to lower the amount of tax that they pay. Because the Australian corporate, as we mentioned before, the Australian corporate tax rate is, it's not ridiculously high, but it's not the lowest in the world. But, and if you haven't seen this story, there is actually another wrinkle to it. Because Ikea now is not Swedish anymore. It's actually owned by a Dutch organization. And that Dutch organization is actually not a company. It's a charity. So they're not actually even, ultimately, they're not even owned by, and I don't know Dutch tax laws. I don't know how charitable foundations work in terms of the amount of tax that they pay over there, but I'd imagine that a charitable foundation probably has some tax breaks going on over and above what you see a normal company in the Netherlands. Pretty sure Dutch is Netherlands, yeah. The Netherlands work. So I mean, again, it's one of those classic stories of how the corporate structure works to try to shift profits to reduce a real cost. You're doing ABC, you'll know that if this was all part of one big group, then all those intercompany transfers will get eliminated out and the group will have whatever the group profit is. But the way that tax works is generally paid on, it's not paid on a group level, it's paid on the individual companies. So there's actually very good incentives to have these intercompany transfers and have transfer pricing, because you can actually legitimately, if it's legal to do it. Whether or not you think it is the right thing to do is a completely different thing, but it's legal to do it. So just some food for thought. And on that note, we'll take a break and then we'll get into the major example and a few other minor things that we need to deal with.